Okay, now today we are going to do the share-based payments. One of the another area which are very prominent in the examination, and some of the people who has attempted the papers, they told me, sir, from this area so many questions has been asked. Okay, so in the mock test, so we will complete it today in this class. So in the share-based payments, what is a share-based payments? One of the very, very big problem with the companies or any entrepreneur is the labor turnout. So whoever your employees are there, you have to hold your employees, and if the employees are leaving the business, your company or your organization, then again you have to train the new people, and that costs you a lot, and a lot of efforts, energy, resources are wasted again and again. You have to incur the training cost, and you won't have a trained, experienced team. So you have to retain your employees with you. Sama. So one of the technique is the share-based payments. In the share-based payment, we have three type of share-based payments. The one is ESOP. Another one is ESPP. The third is ESOP stands for Employees Stock Option Plan. Employees Stock Option Plan is the ESOP. ESPP is Employees Stock Purchase Plan. OP is Option Plan, PP is Purchase Plan. Third is Shares Appreciation Rights. Shares Appreciation Right. The first one, ESOP, is on some obligation. If the obligations are fulfilled, satisfied, the employees will be issued the shares of the employer at a reduced cost, than the fair value. Say, what is fair value? Who can tell me? Fair value of share. What is fair value? Anybody? Any one of you? What is fair value of share?
Market value, sir.
Market value. So market value and the fair value, there is no difference. Acha. Chetan ji?
Yes, sir.
What is fair value? Is it market value? Anand is telling it is a market value. Is it market value? Or it is different?
It's like a comparison with the market value.
It is compared to market value. So it is almost all market value. This is what you say. Market value जैसे
Sir.
market value है. हाँ जी. Okay. Yes, Vaibhav. Is there any difference between the fair value and the market value?
Sir, fair value can be assumed at market price within reference to the declared dividend and everything else.
Mm-hmm. Is it one and the same? Fair value,
So,
market value.
in the holding subsidiary, we used to do we used to subtract the declared dividend price. So that price is going to be added in the share value if we sell it in the market.
Acha,
So that could be included in the fair value.
acha. Urushi, is there any different answer for it from you? Urushi, intrinsic value plus yield value by 2. Okay, right. We are not doing that. We are not doing valuation of shares. Okay. In that you can say that yes, intrinsic value plus yield value divided by 2. Otherwise, what is fair value? So she has completed valuation of shares and valuation of goodwill. Nice. Right. Srimant. Yes, Srimant. What is the fair value?
Value.
Fair
Market value,
value
sir.
and market price. Both are same. Almost. So what is the difference?
Sir, on written on
Hmm.
and sir, share divided by outstanding share.
Acha. So people, okay, right. Most of you are telling differently. Okay, right. The value of the shares, the market value and the fair value are two different ones. The fair value is the knowledgeable seller purchasing from knowledgeable buyer in the perfect market, then we call that as the fair value. Okay, these are the formulas. Whatever you have written is a formula. We cannot take this as the perfect one or thing like that. The fair value we calculate is a equilibrium value. So we calculate by applying different methods, and very familiar methods are those who are doing both the groups. They must be knowing. Must be knowing because he is giving both the groups. I think so. So other people, those who are giving both the groups, third and fourth group, they should know this. The fair value is calculated by the different methods, and one of the very superior methods are Black-Scholes method and binomial method. So and CAPM. So these are all the different methods are there to find out what is the fair value of the shares. The fair value of the shares meaning is that is the supposed to be the value for those shares. So that is a fair value, and the market value is the prevailing in the market, and it fluctuates a lot. So market value overreacts. Market value overreacts in the sense, suppose that today's value is 100 rupees. Let's say that a new government has come, or the existing government has existing government in let's say US, Trump is going out and Biden is coming. So the market in India will be increasing or decreasing. Market in India, why should they increase or decrease with the another countries? About the political change in the politics. If suppose somewhere in Africa some war is happening, then India, the price will come down. So like that, so the market price, it varies, it fluctuates, it overreacts. So we cannot take that as the right value, fair value. Fair value is what you say is exactly what you're supposed to be the value of the shares, that we call it as a fair value, which we can find out by CML, SML, CAPM model. Then yes, some of you said the dividend model, somebody said, and Black-Scholes model, and blah blah blah. So different models, we find out the equilibrium price, the fair value we call it, and but the market price, prevailing price. We don't consider the market price because the market price cannot be the exact fair value. Reason is market overreacts. Today something will be there, something had happened, it will fall down. Something had happened, it will increase, shoot up so much. So that is the reason we don't consider in valuation, we don't consider the market price, we consider only the fair value, right? So let us come to the part of this one. So here in the ESOP, so why we are discussing later on, you will understand that why I have discussed about the fair value. Okay, right now ESOP is employee stock option scheme on fulfilling some conditions. On fulfilling some conditions, if the shares are given to employees of the company, then we call that as the ESOP, employee stock option plan. So the value will be lesser than the fair value. The value will be lesser than the fair value, not the face value. It will be much more than the face value, but lesser than the fair value. Fair value is 50 rupees. They might issue to the employees, those who are fulfilling the conditions, they may be issuing at 45 rupees. So that way it is lesser than the fair value, not lesser than the face value. Okay, so this is one part. But in case if the problem they have not given the fair value, then we have to take the market value as the fair. Market value and fair values are not one and the same. We will be considering market value equal to fair value when the fair value is not given in the problem. Okay, right. That is the ESOP. Another one is employee stock purchase plan. Employee stock purchase plan is when there is a public issue. When there is a public issue by the employer, some of the shares are allotted to employees. Employees are given given opportunity to buy the shares of the employer. So that is the employee stock purchase plan. Here there is no ESOP, there is no public issue. When ESPP, there will be a public issue, and there the employees are given at some concessional rate, or it might be whatever the rate issued to the public also, might be, it is up to the management what they decide. Okay, see the shares, whenever you have to buy, you will be buying a lot. A lot consists of 500 shares, 1000 shares. So in the multiples of thousands, in the multiples of 500 only you can buy. If someone wants to buy 200 shares, he cannot buy 200 because minimum you have to buy, if the lot is 500, then minimum you have to buy 500 and in the multiples of 500. Suppose let's say in the multiples of 500, you can buy 5,000, you can buy 2,500, you can buy 1,000 shares, but you cannot buy 1,250 shares because it is not multiples of 500. So the shares are issued to anyone, whether it is a public or to anyone, employees or whoever be. It will be issued in the lot. So what happens? Sometimes you might be knowing this, and the Pfizer company, they are issuing the shares at the price band of 1450 to 1550. This is the advertisement. Every day it is coming in the news, the electronic media and the print media. The face value is 1 rupee. The face value is 1 rupee, and the price band is 1450 to 1550. This is the news advertisement. It is coming everywhere. Every day it is coming in all the electronic medias and all the print medias. So suppose if I want to, company is giving me ESOP or ESPP, 3,000 shares they are giving. The lowest price is 1450. Even if I'm taking at this price, 1450 into 3,000, I have to spend how much? It is 43 lakhs. For 3,000 shares, it is coming rupees 43 lakh 50,000. Poor employee, where he will go and buy this, spend 43 lakh 50,000? Isn't it? To get some, might be the market price, the fair value might be 1,500, issued to the employee at 1,450. For getting the benefit of 50 rupees, how much he has to shed? He has to spend 43,50,000. The employee may not have that much money with them. So the option will be lapsed. He won't able to exercise his option. So what is the way out? Employees will be going out. Our purpose is to stop the turnover, employees turnover, labor turnover. So how to stop it? So here the another method is there, that is SAR. The SAR is stock appreciation right. The stock appreciation right.
You're on mute.
Is it for quite some time I was mute?
After you wrote that 1450, that arrow,
Okay.
I didn't hear anything.
Okay, right. See, 1450 is the rate on the date of declaration of the option. And after the vesting date, this and all we'll be discussing in a while. So the difference 1450 and 1500, 50 rupees is your concession, your benefit, the employee's benefit. This 50 rupees will be paid in cash by the company. Instead of you spend 43,50,000 to buy 3,000 shares. 50 rupees for 3,000 shares will be given in cash to the employees. So how much is this? This is 1,50,000. So 1,50,000 will be paid to the employees as share appreciation right. So this is the third one. Because all the employees cannot invest that much money, they may not have the cash, and company cannot give a loan for purchasing their shares to the employees. So that is the reason the amount is paid in cash. Whatever the appreciation is there, the difference in rates are there, that would be paid in cash to the employees. So that is the third one, SAR, SAR. Okay, share stock appreciation right. Okay, right. So before going to, so that is the background of share-based payments. Any doubts, anyone, before I'm going to the technical? If anyone wants to ask something, any doubt you have, you can ask me now. Anyone? Any doubt? So no doubt. Okay, right. Okay. Now, some of the terms let us understand. Okay. Some of the terms let us understand. Who doesn't know about the share-based payments? Who has not done at all? If everybody knew these terms, then straight away I'll go for the problem. Because without understanding the terms, we cannot go for the problems. So,
Mechanically, we don't know what the terms mean, sir.
okay,
We
right.
just go.
The terminologies I was talking about the terminologies. Have you done the share-based payments earlier? Any one of you who have not done at all? No. Right. Have you done the Esop anytime? Any one of you never done these areas or don't have understanding about it? What should I take as nobody is answering me? Should I take you knew this or no one knows? I answer me. I don't know. Okay. We have done my bow. Okay, right. Who has not done? If whoever has done, say yes. Okay, right. Only Vaibhav has done, so I have to do now. Okay, right. The first one is the grant. So the meaning of the grant, okay, little, okay, right. So the grant means, grant is something the company is giving to the employees. Whatever the company is likely to give the employees to retain them, that is the grant. Whatever likely to give, reward the employees, that we call it as the grant. So it is a reward by the company to employees to subscribe. Subscribes for equity of the company. So that is grant. So suppose they say that we will be issuing you 30,000 shares, 40,000 shares, 3,000 shares, 30 shares, 20 shares, like that. So that we call it as a grant. And the next one is the grant date. Grant date is the date in which the grant is announced. The grant date is the date in which the grant is announced. So the resolution will be passed and it will be approved by the shareholders to issue shares under ESOP or ESPP or SAR. So that date we call it as the grant date. The date the resolution is passed, that date is the grant date. So the date at which resolution is passed. For the grant. To the employees. So this we call it as grant date. Okay. Next is vesting. Vesting means entitlement. Acha, I'll ask you something. Yes, Anand, can you tell me anyone? See, there is a direct entry is there for the inter. No need to do the foundation straight away. You can get the registration for the inter. Is it possible directly get registered for final without completing the inter?
Not possible, sir.
Not possible. So someone has to register for inter to become a final student. Then he has to clear his intermediate, isn't it? Both the groups of
Yes, sir.
intermediate. He has to complete the intermediate. Am I right?
Yes, sir.
Okay, right. So the entitlement to register for final is completion of intermediate. So intermediate gives you the entitlement. Similarly, to get enrolled or registered for your intermediate, either you have to complete your foundation or direct entry, graduation, something like that. Okay, or cleared the foundation of other groups, cleared some other professional, this one CA, CMA, CS, and you can directly get the admission in the intermediate. So that is the entitlement. So that we call it as vesting. When you get empowered to do something, that we call it as vesting. So here the vesting means entitlement. You are eligible for option. You are eligible for opting the shares, exercising your options. Then we call it as vesting. Another one is vesting period. Vesting period, before that I have to, what is vesting date? Vesting date, the date at which the employees become eligible for vesting. The date at which the employee become eligible for vesting is the vesting date. And what is vesting period? Okay. What is the vesting date? The date. So when can you register for the final? The date you complete your result is declared and you have cleared your intermediate, and that is the date you are eligible for registering for final. So that is the date that is giving you the entitlement to register for the finals. So that date we call it as the what? Vesting date. Like that, if you are eligible for entitlement, that date is the vesting date. See, suppose the company says you have to work continuously 3 years, you have to be there in the organization, then you will be allotted 1,000 shares. Continuous service of 3 years. So, sorry, someone is joined on 1/1/2020. So if he is completing 3 years continuous service, when he will be completing? He'll be completing on 31st December 2022, 2020, 2021, 2022. So 3 years completion will be on 31st December 2022. He will be eligible on 1/1/2023 for the reward. So this period we call it as a vesting period. The period 1/1/20 to 31st December 2022, we call it as the what? Vesting period. So there will be some conditions. The condition period is known as vesting period. On fulfilling the conditions, you will get the reward. You will be vested with the entitlement. You will be vested with the award or reward. So that period we call it as the vesting period. So that the period from the date of grant to the date of vesting. The period from the date of grant to the date of vesting is known as vesting period. Okay, now we have discussed grant, vesting date, vesting period. Any doubt in this? Anyone has any doubt? Anyone has any doubt? Shall I proceed further? Okay. Right, now the next is excise price. Excise price is the price at which the shares are issued to the employees. The price at which the shares under Esop is issued to employees. That we call it as what? Excise price. So excise price is the price which is less than the fair value. So that is the price at which the employee has to subscribe for purchasing the shares under ESOP. Okay, that we call it as the excise price. Excise period. Excise period. I forgot to ask every one of you. Everybody has registered for your home-based or center-based exams. Have you applied for that?
Yes, sir.
Yes, everybody has registered. Okay, right. Was there any window was given from this date to this date? You have to give your option, something like that. And I think it is extended also. Am I right?
Yes.
What is the date? It was from this month. This month, 1st November to 12th November, something like that was there. Am I right?
Up to
Yes, sir.
12th November, sir.
1st November to 12th November.
Right, yeah.
I think now it is extended also. Am I right?
Don't know,
Yes.
sir, because they say that we don't register by
It got
12th.
extended till 15th, sir. 1/5.
It got extended till 15th. So that period is over now. That window is closed.
Yes, but they are still rectifying all the. I mean, if some error has happened, they are rectifying it. But new registration or that option is closed. Whoever has not registered, they have put them in the center-based in default.
Okay, they have to go to center and enter, right? Suppose somebody has not opted, who wants to do the home-based this one. What happens?
No, sir, by default it comes as center-based. You can't
Sir,
change it.
you can.
don't-
I mean, we should not say in this platform. I mean, but as it's not being recorded, I can say that you can send it to the institute. There's a mail ID for that, and there you can say that by mistaken we have opted for center based and we want sort of system error.
Okay, right. Suppose it is like that. So we are writing the November exam. Okay, let's say that June is merged with December. So we are, but somebody has to apply for the November exam. What was the period? It was from, if I'm not wrong, 1st September to 10th October. Isn't it? For November exam, if you have to apply.
For December exam.
Sorry. Sorry, friends. For December exam, if someone has to apply, someone has to enroll, then he has to enroll between 1st September to 10th October. I think 30th September without penalty, and after 30th September from 1st October to 10th October with some penalty, you can enroll for your December exam. Am I right?
Yes, sir, this was the usual date.
Usual date. I'm talking about the usual. Okay. It was the usual date. Okay, right. Suppose somebody has cleared his intermediate and registered, and those 9 months period are completed. He has to, so he's entitled for giving his exam in December. Suppose if he's forgetting to register by 10th October, what will happen? Can he give the exam later on? Can he send a mail to the institute saying that please consider I have forgotten, and please kindly consider my application. I would like to give my exam in December. Is it possible? Is that possible? Are you getting me? No one is
I
talking.
couldn't understand the question.
Okay, right. See, I'm eligible to give exam in December for the final. Okay. I have to register from 1st September, whatever the year, 2020, let's say, to 10th and 2020. I have to apply within this date, isn't it? I have to enroll for the December exam within this period, isn't it? Am I right?
Yes, sir.
Right. Suppose someone has forgotten to enroll within this period. He could realize that he has not enrolled for the December exam on 15/10/2020. What is the way out for him? How can he give his exam for the December? Is it possible to give the exam in December by requesting the institute?
No, sir.
No, no way you can do it. This is the window given. If you are not doing, then it is lapsed. You cannot do it. You can write the exam only in the June 2021, not December 2020, because this is the period. Okay. So similarly, after the entitlement, when the vesting is, you have vested for the option, you have vested for the option, and you will be given some window. Between this period, you can opt, you can excise your option. So that period we call it as excise period. So like that, the 1st September to 30th September, yeah, 1st September, some days, 1st November to 15th November. Like that, the window was given. So you may give it on 1st September, 1st November, or you may opt it for 7th November. You may do it on 12th November. You may do it on 15th November. But beyond 15th November, you can't do it. Between 1st November to 15th November, you can opt for either home-based or the center-based exams. Okay. Similarly, here, after vesting, period will be given to pay the money. So the day you pay the money, that is, you are exercising your options. If you don't pay within the period, your option get lapsed. Okay. So excess period is the period. Is the period available to the employees to, I'll not say, to subscribe the option. So the period, whatever the period is given, that period is excise period. And the day you are paying the money, that day is date of excise. The date the money is paid. By employee is known as excise date. Then you have lapse of option. Vested and lapsed. The lapse can be lapsing, lapse of option can be because of the two reasons. One is you are vested but not opted. So you have become entitled for, you have completed the period. So I'll tell you here, we have discussed earlier, 3 years period, if you are continuous service of 3 years period, will give you the shares in the ESOP, employee stock option. You will be getting the shares under the employee stock option at a reduced price. So you have completed 3 years of continuous service. You have completed, then you are eligible for the entitlement of shares under ESOP. But what happened? You don't have money. So here every employees are given 3,000 shares at rupees 200 per share after completing 3 years of continuous payment. Okay, you joined on 1/1/2020 and you completed 3 years on 31st December 22. I will take this 1/1/2000, 1/1/2017. Completed on 31st December 2019. 3 years services you have completed. You are eligible for 1/1/2020 for 3,000 shares. And you have to, excise period is 1/1/2020 to 15/2/2020. So you have to pay the money, 200 rupees, 3,200 is how much? 3,000 into 200 is 6 lakhs. To get this shares, 6 lakhs you have to pay. Market price is on the date is, let's say, fair value is rupees 300. So if you buy market, at least you have to pay 9 lakhs rupees. Fair value is 9 lakh rupees, but you are getting for 6 lakhs rupees. But you have to have 6 lakhs to buy it. Or the company should perform better way so that they will buy the shares. The company is not performing well, or you don't have the money. You means employee doesn't have the money in his hand to buy 6 lakhs. So how he will be buying? So he will not opt, he will not exercise his option. He is vested, but he could not exercise the option because of shortage of money, or he does invest in the company because the company is not performing well. So that is not vested and lapsed. Somebody is leaving at the end of second year, before completion of third year, he is leaving and going. Then automatically it lapses. He is not fulfilling the condition. Condition is what? If you complete 3 years of service, you will be allotted with 3,000 shares at a lesser price, which is 200 rupees, lesser price than the fair value. Fair value is rupees 300. So how much is benefited per share? He has benefited 100 rupees. For 3,000 shares, he will be benefited by 3 lakhs rupees. To get the benefit of 3 lakhs rupees, how much would be his cash outflow? 6 lakhs rupees. If he doesn't have the 6 lakhs, then he won't buy those shares. Or if he feels that it is not worth to buy the shares from the company, he will not buy. So he is vested and lapsed. Another one is, if somebody is not completing his 3 years of service, then he may be leaving and going, not fulfill the obligation and lapse. Are you getting this? Everybody is getting this. What is the lapse? Lapsed, vested and lapsed, and simply lapsed. Okay, right. Now we are going for the problems. Okay. Before that, one more term. Fair value of option. Fair value of option, or intrinsic value of option. So means this is the benefit to the employees opting for ESOP is fair value of option. The fair value is the value of the share. Fair value of the option is what the benefit the employee is going to get. So in the previous one we have been discussing. So here the excise price is rupees 200. Fair value of the share 300 per share. How much benefit the employee will be getting? How much he will be getting? The fair value, at least that will be the market value. It won't be, yes. So the 100 rupees, we call it as fair value of the option or value of the option or intrinsic value of the option. So fair value of option, value of option, intrinsic value of option is one and the same. What the benefit to the shareholder, the employees by exercising the option is the fair value of the option. So here 100 rupees is the, so here fair value option is rupees 100 per share. That is 300 rupees minus 200. So till here, any doubt is there? Is there any doubt? Is there any doubt?
Fair value, intrinsic value, both are same.
Fair value of the option, intrinsic value of the option, not fair value. Fair value means the value of share. Fair value of the share is 300 rupees. Fair value of option or intrinsic value of option. If the option is not there, it is the value of the share. If the option is there, then that is the benefit to the shareholder. Fair value is different from fair value is not equal to fair value of here the fair value is 300 and fair value of the option is 100. That is a benefit. Fair value means is a value for the share, equilibrium value for the share. Fair value of the option is, this is the one. Fair value of the option and fair value is totally different. Okay, so fair value here is 100 rupees and fair value of the option is rupees 100 and fair value is 300. Getting it? Got it? Brahmpal, namaste. For joining after a long time. Good to see you. Okay, right. Any doubt? Any doubt? No doubt. Okay, right. I'm going for the problem. I have sent you some problems in the group. Please kindly go for it and we'll do the book problem also. Let us first understand the problem which I have sent you. Sheetal, can you read the problem?
Yeah.
In the PDF, what I have sent, that one you have to read.
Yeah. First one is Esop vesting period less than 1 year. Okay.
Yeah.
So, okay, the problem goes. On 1st April, a company offered 100 shares to each of its 400 employees at 25 rupees per share. The employees are given a month to accept the shares. The shares issued under the plan shall be subject to lock-in to transfer for 3 years from the grant date, that is 30th April. The market price of shares of the company on the grant date is 30 rupees per share. Due to post-vesting restrictions on transfer, the fair value of shares issued under the plan is estimated at rupees 28 per share. Up to 30th April, 50% of the employees accepted the offer and paid rupees 25 per share purchase. Nominal value of each share is 10 rupees. Record the issue of shares in the books of the company under the aforesaid plan.
Okay, right. So here the entries I have not discussed. Okay, right, Bhampal. Right. So here, so now, how much is, when the fair value is not given, we have to take the market value as the fair value. When the fair value is not given, the market value should be considered as the fair value. Here, the market value is so much. On 1st April, the company offered 100 shares to each of the 400 employees at rupees 25 per share. 25 rupees is the excise price, and the employees are given 1 month period. So here the excise period is 1 month. The shares are issued under plan shall be subject to locking period of 3 years. Grant date is 30th April. The market price of the shares at the time was 30 rupees. Due to post-vesting restriction on transfer, the fair value of the shares are issued at 28 rupees. So here the fair value is also given, market price also given. Which one we have to take? We have to take the fair value. Okay, so the first one, PDF page number 1. Question number 1. Okay. Just calculate what is the total fair value of option or total intrinsic value of the option. Let us find out. Okay, fair value. Okay, number of grants. Number of grants, how much? Number of grants will be 100 shares for how many employees? How many employees? 400 employees they have given. Okay, so into 400 employees. So the total grant will be 40,000 shares. So this is the total grant, number of grants, total number of grants. Okay. Minus grant lapsed. How many people not opted for the grant? 50% people opted and 50% not opted. So grant lapsed 50%, 20,000. So number of grants will become 20,000. Here fair value of option will be fair value minus excise price. So fair value is how much? Fair value is 28 rupees and excise price is 25 rupees. So fair value option is rupees 3 per share. Total fair value of option will be 20,000 into rupees 3. Rupees 60,000 is the fair value of the option. So fair value of the option is rupees 60,000. So this is the first question. Getting this? Are you getting this? Any trouble in this?
No, sir.
Okay, right. Let us go for the second problem, please. Yes, Sheetal.
So, 1 minute. Problem 2. Okay, here also Esop vesting period less than 1 year. A company has its share capital divided into equity shares of rupees 10 each. On 1st October 2017, it granted 20,000 ESOPs at 50 rupees per share when market price was 120 rupees per share.
Okay.
The options were to be exercised between 10th December 2017 and 31st March 2018.
Okay.
The employees, exercised their options for 16,000 shares only, and the remaining options lapsed. The
Okay.
company closes its book on 31st March every year. Show journal entries with narration as would appear in the company's book up to 31st March 2018.
Right. Before this, I'll tell you what is the entry we have to pass. That we will discuss first, then we can go for it. Okay. So earlier, what was this one? Earlier it was there. Okay. As per accounting standards, this is a entry, and as per Ind AS, the entry is little different. Okay. So this is the earlier we have been using, before Ind AS we have been using. So the old one. So this will be for recognizing expenses. So this is when the period is less than 1 year. The entry will be for recognizing employees. Compensation expenses account debit. 1 minute. And allotment of shares. Bank account debit. Employees compensation expenses account debit to equity share capital to security premium. हमेशा security premium में आएगा because it will be more than the face value. So security premium account. So this will be the entry. So in this case, what will happen? The number of shares issued is 20,000. So here 20,000 into 10. How much is this? 2 lakhs. Okay. And security premium, it is issued at 28 rupees, isn't it? So 20,000 into 18. How much is that? 20,000 into 18. 3,60,000. 20,000 into 18. 3,60,000. And we are getting 25 rupees. So 20,000 into 25. 5 lakhs. And here the 60,000 we will be employees compensation expenses will be there. So this is we will be doing in generally in the old method. Now it is differently, it is done after the day. This is what you have to follow now. So as per study material. What we'll be doing here is bank account debit. Very big difference. You must notice. Very, very big difference. See, पहले था employees compensation expense, now it has become employees expense. कितना difference? Big difference, no? Only this is only the difference. बाकी everything is same. 2 equity share capital and instead of writing premium, security premium, we will be writing other equity. But that's it. Instead of writing premium, we will be writing other equity and within bracket security premium, not straight away security premium. So this is the way, even if you're writing security premium, nobody will reduce the mark. But here it is a system based. So in the system, whatever is fed, that only will be coming. It is not manually valued. Therefore, you write whatever is there in the book. Similar thing you have to write here. So the bank will be how much? It will be 5 lakhs and 6 is 2 lakhs and 3,60,000. Thus, this is what you have to write here. How do we get this 50,000? 20,000 into 20 into 25, yes, and 20,000 into whatever the option value or fair value of the option, 3 rupees. 20,000 into face value, 10 rupees. 20,000 into premium, that is 18 rupees. So this is what we have to write. If it is within 1 year, less than a year, this is the entry we'll be making. Is that clear? Is that clear? Are you getting this? Are you getting this? Yes, friends? Okay, right. Now we'll go for the next. Anand, are you getting this? Anand?
Yes, sir. Very much.
Okay, right. Okay, right now the second problem. Yes, Sheetal, go for the second one. So if it is more than 1 year, before that I'll give you the this one entries. Okay, if vesting period is more than 1 year, I will not confuse you. Only whatever the current entries are there now in the books are there. That is only I'm going to make it, and that way it will be helpful for you. Okay, so for recognizing expense, the entry would be employees expense account debit to share based reserve account. It will be shown under other equity. This entry will be making every year on allotment. What will be doing? Bank account debit employees expenses account debit to equity share capital to other equities. Instead, you can write the security premium, nothing wrong there, or security premium account. To general reserve. If you write here security premium, then you can write under the instead of general reserve, you can write other equities. So these things what supposed to come, you know, but in the general reserve here, what we will be doing. This will be fair value of option in respect of vested options lapsed. So this will be, the amount will be fair value of the option in respect of vested options lapsed. So how this is, blank paper is in. Is it so? My sharing is not happening? Screen sharing is happening or not?
Perfect, sir. Screen sharing is.
Screen is, now you are able to see the screen. Visible, na? Okay. Brahmpal, you re-admit yourself. You can see that. Okay, right. Now, yes, second question, please. Now. Second question, please. Sheetal.
Yes, sir, yes, sir. Second, okay. Vesting period less than 1 year.
Yeah.
Okay. A company has its share capital divided into equity shares of rupees 10 each. On 1st October 2017, it granted 20,000 employees stock option at 50 rupees per share when market price was 120 rupees per share. The options were to be exercised between 10 December 2017 and 31st March 2018. The employees exercised their options for 16,000 shares only, and the remaining options lapsed. The company closes its books on 31st March every year. Show journal entries with narration as would appear in the company's books up to 31st March 2018.
Okay, right. So here, total grants are how much? Total grants excised 16,000 shares. That is what given in the problem. Total grants excised is, you say here, 5,000 employees, company issued 10 rupees shares. It granted 5,000 employees stock option of rupees 50, and the options were excised on 112 no, not this one. The company share capital is divided into 10 rupees shares and 110/2017. It granted 20,000 employees stock option and 16,000 were excised. So 16,000 is right. So fair value of option, how much? The market price they have given as 120 and they are giving it 50 rupees. 120 rupees is the market price and 50 rupees they are issuing. Therefore, the benefit to the shareholder is 70 rupees. So fair value of option is 70 rupees per share. So total fair value of option. How much it would be? 16,000 into 70. So how much is this? 16,000 into 70. 16,000 into 70 is rupees 11 lakh 20,000. Rupees 11 lakh 20,000. So let us go for the entries now. Now bank account debit. Employees. Expenses account debit. To share capital. Equity share capital. To other equities within bracket security premium. Even if you write security premium account, nothing is wrong. Okay, right. So here, how much you are getting? 16,000 into 50 rupees you are getting. So this is 8 lakhs. And total grant is 11 lakh 20,000. This will be 16,000 into 10. 160,000. And this is 16,000. 120 minus 50. Sorry, 120 minus 10. 120 minus face value. So 110 into 16,000. 110 into 16,000 is 17 lakh 60,000. 17 lakh 60,000 total is 19 lakh 20,000. You have the 19 lakh 20,000. Getting this? Any doubt? Is that clear? Is that clear?
Yes, sir.
Okay, right. Let us go for problem number. The fifth problem. More than a year.
Yes, sir.
Greater than a year. So that is page number 4, 5,
4.
4. Okay, PDF page.
So problem number 5, right?
Yeah,
Yeah, page number 4.
person number 5. Okay, do it. Read it.
Yes. So here the vesting period is greater than 1 year.
Yeah.
And the problem goes, a company grants 1,000 options to its employees on 1st April 2015 at 60 rupees. The vesting period is 2.5 years. The maximum exercise period is 1 year. Market price on that date is 90 rupees. Assume all the options were exercised on 31st July 2017. Journalize if the face value of equity share is rupees 10 per share.
Okay, right. So here vesting period is how many years? 2.5 years. Vesting period is 2.5 years. Okay. And first year. All these things will be done at the end of the year. You will be recognizing the expenses end of the year, and like our straight line depreciation. So total expenses divided by number of years. If you do it, then you get the amount to be recognized every year that we will be appropriating from our profit and loss account. Okay. So here, first year, 1,000 option to its employees at 60 rupees. The vesting period 2.5 years. The value of the maximum excise period is 1 year. Market price of the share is 90. Assume that all the options were exercised on 31st July 2017. First year, which year? This is 1/4/2015. Okay, so first year 2014-15. Okay, next, fair value of option. Market price is 90 rupees and the excise price is 60 rupees. So fair value of the option is rupees 30 per share. Number of grants. How many grants are there? 1000 shares. Total fair value of option is rupees 30,000. So total fair value of the option 30,000. So expenses to be recognized. So first year 2015-16, 30 lakh, 30,000 divided by 2.5, so 12,000 per annum. 2016-17, this is the second year. This also it will be 12,000. And 2017-18, it will be 12,000 into 1/2. So 6,000 for the third year. Okay. So this is the amount we will be recognizing as the expenses. For recognizing the expenses, what is the entry? So first, employees expenses account debit to share-based reserve account. Then, okay, employees expenses account debit to share-based reserve account. Then, end of the year, we will be doing the profit and loss account debit to employees expenses account. That is the way the employees expenses will get closed. Employees expenses account debit to share-based reserve account, share-based reserve account or other equity accounts, and this will be written off to profit. We'll appropriate from the P&L account. So profit and loss account debit to employees expenses account. This is what we have to do every year. Since there is no need to less than 1 year, straight away we take it to the expenses. We straight away take. We don't recognize the expense separately. We don't do it. We don't do any appropriation. Since here it is more than a year, then we have to follow the conservatism principle. We have to create the reserve. Then we have to wait. Okay. So in this, the entry first 31st March.
How are we taking 5 years?
So total 30,000 is the expense.
No, sir. The division buys it to 5 years. It's on.
It is 2.5 years. Period is 2.5 years. That is what given here, if I'm not wrong. The vesting period is 2.5 years. So before vesting period, we have to get ready for this expense.
Reading the exercise.
Hanji, your voice is not.
I was reading the exercise date, sir. Sorry.
Oh, okay. So before vesting period completion, we have to create this reserve. Okay, ji. Shall I proceed further?
Yes, sir. Yes, sir.
Okay, ji. Right. So employee expenses account debit to share-based reserve account. How much is that? First year 12,000 will be created. 12,000. Okay. Then profit and loss account debit to employees expenses account. So only reserve will be there. Okay. 12,000. This entry is not there in the book. P&L account debit to employees expenses not there in your study materials. So don't worry about it. Try it in the exam also. You can avoid the, you can save the time. So if it is asked, you need not to. This is not necessary. This entry is not necessary, not mandatory. I won't say it is not necessary. It is not mandatory. If you don't do this entry also, you'll be getting the marks. So 15, 16 is over. Then 31st March 2017. Again, the same thing. Employee expenses account debit to share-based reserve account. So excuse me, 1 minute. So share-based payment reserve account. Employees expenses account debit to share-based payment reserve account. So second year also we will be providing 12,000 we will be recognizing. So then profit and loss account debit to employees expenses account. So second year is over. Second year is over. Third year. 30th September 2017. Employee expenses account debit to share-based payment reserve account. Here 6,000, 6,000. Okay. Then same date 13/9/2017. Profit and loss account debit to employee expenses account, because this is the date you have to allot the shares. So we'll be doing this. Now allotting the shares will be different date, isn't it? Allotment of shares is 1 year later. So we can take this 31st March 2018. You can take it 6,000, 6,000, because the excise period is later. So now allotment of shares The date is not given. So you can put a question mark. The entry would be, what is entry? Bank account debit. Share-based payment reserve account debit to equity share capital to other equity account within bracket security premium. How much you'll be getting? Here. You'll be getting here 60 rupees you are issuing. So here, how many shares are there? 30,000 shares. So 30,000 into 60. So 30,000 into 60 is how much? So this is, am I right? 30,000 to 60 is 18 lakhs, if I'm not wrong. So this is 18 lakhs. And how much is the reserve you have created? So total value of the option is how much? Total option is, oh sorry, this is only 1,000 shares. We have 1,000 shares, sorry. So this will be 1,000 into 60, 60,000. The value of option is 30,000, so 30,000. And here 1,000 into 10, 10,000. And 1,000 into 90 rupees is the market value minus 10 rupees the face value. So this becomes 80,000. So this is the way we will be doing this. Are you getting this? Are you getting this? Okay, others? Okay. Others? Are you getting this? Chaitanya is also okay. Anand, getting it?
So I have a doubt.
Yes. What is it?
So the state that assume all options were exercised on 31st July 2017. So there's nothing to be done on that date, 31st July.
31st July it is exit, but allotment is only on 31st July. It is a printing error. So it's supposed to be 30th September 2017.
Okay.
It is not 31st July. It's supposed to be 31st because any company has to follow the financial year as their accounting year.
Okay, sir. Got it.
Okay. So that is a printing error. We don't know the allotment date because they say 1 year is the excise period is a 1 year they have said. So that is the reason. The excise options were excised, but allotment when it is to be done, it is depends. Okay. Right.
Okay, sir.
Right. So now let's go for, so if there is a lapse, so what we have to do? There will be a choice limited will be there, which is I think PDF page number 5. Am I right? There will be a problem number 7. Yeah, problem number 6. Listing period here. Next problem. Cheater. Next is 6. Problem number 6.
Okay, here also the vesting period is greater than 1 year.
Yeah, now we'll be doing all the problems more than a year.
Yes.
Okay.
A company grants 1,000 ESOPs on 1st April 2015 at 40 rupees when the market price is 160 rupees.
Hmm.
The
So
vesting
here, how much is the value of option? How much is the value of option?
120, sir.
120. Very good. Okay, right. Proceed, please.
The vesting period is 2.5 years and the maximum exercise period is 1 year. 300 unvested options lapse on 31st March 2018. 600 options are exercised on 30th June 2018. 100 vested options lapse at the end of the exercise period. Past journal entries giving suitable narration.
Okay, right. So this is the problem I was looking for. So we have been doing all these problems, the warm-up problems till now, to do this type of problems. So there is a options lapsed, and there are vested option lapsed also there. Okay. So how we have to do? Let's see here. Mm, okay. Right. Now, so here also it is 2.5 years. This is question number 6. PDF page number?
Yes, sir.
PDF pages?
5.
5. Okay. So here, write your folio number. Debit credit rupees. So here, value of option or fair value of option. Fair value of option is 160 minus 40 rupees 120 per share, and number of 1,000 employee stock options. Grants are 1,000. The vesting period 2.5 years. Maximum price, maximum period is 1 year. Excise period 300 unvested option lapsed on 31st March 2018. Here when they are issuing it 1/4/2015. Okay. So on 31st March 2018, 600 options were excised on 30th June 2018. So that is 31st March 2016. Okay. So here number of grants. Here only number of grants here. Number of grants. 1,000. Total fair value of option. Total fair value of option. Total fair value of option is 1,000 into 120. 1,20,000. Okay. Expense to be recognized will be 1,20,000 divided by 2.5. So this is how much you have to recognize. So 120,000 divided by 2.5 will be how much? 1,20,000 divided by 2.5. Rupees 48,000. End of second year. 31st March 2017. 31st March 2017. Okay. So here also rupees 48,000. On 31st March 2018. Number of grants. 1,000 grants were there in that 300 unvested option lapsed minus 300. So number of lapsed because they have not completed the fulfilled the condition, satisfied the condition. Therefore, these grants are lapsed. So 700 grants. Total value of option. Total fair value of option. 700 into 120. So that is 84,000 rupees. Okay. Less already recognized. How much you already recognized? We have recognized 96,000. So option to be 1 minute. The vesting period is 2.5 years. Period 300 invested option lapsed on 31st March 2018, and 600 options were exercised on 30th June 2018. 100 vested option lapsed at the end of the exercise period. Okay. So that we can see later. So already recognized 96,000 amount to be reversed. Amount to be reversed 96,000 minus 84,000. How much is this? 12,000. We have to reverse this. These options are okay. All right. Right. Now we'll go for the entries now. Achha, already we have made the we provide the it's already there. Right. First we have to do it on 31st March 2016. 31st March 2016. Or recognizing option. What entry? Employees. Expenses account debit. Share based payment. a reserve account. So first year, how much we have to recognize? We are recognizing 48,000. Then second one, we have to transfer to P&L account. Okay, transfer to P&L account. So profit and loss account debit to employees expenses account. 48,000. Right. 31st March 2017. These are the same entries you have to do it. 31st March 2017 also. The same entry we have to make. 31st March 2016, 17. Dono, we have to make the same entries. Right. In the examination, don't do this. Write it separately. Okay. Right. Now, on 31st March 2018. 31st March 2018. We have to reverse the entry. Share-based payment, reserve account debit to other equities. How much is we have reversed? We have to reverse 12,000 rupees. So generally, general reserve we can transfer. Okay. Excess recognized expense reversed. Okay. 31st March 2018 is over. Then we will not transfer anything to other things. Now 30th June 2018. So bank account debit. Share-based payment reserve account debit to equity share capital account to security premium account. So here, how many finally excise? Number of people excise their option is, they say vested option lapse, 100 vested options lapse, 600 options excised on 30th June 2018, 100 vested options lapsed. So here already we have 700 there. Out of these 700, 100 options lapsed. So number of options vested and lapsed, 100. Number of options excised, 600. So 700 was there, 100 is vested and lapsed, and others are excised. Okay, so we had 1000. not vested and lapsed 300. Vested options 700. Exercised 600. Lapsed 100. So this is what we have taken here. So vested and lapsed 100. Right, let us go for the entries now. To general reserve, you can write other equities also, nothing wrong. So vested options lapsed 100 into 120. That is 100 into 120 is 12,000. How much you have received? 600 into 40. 600 into 40 is how much? 600 into 40 is 2,40,000. We had created 96,000 out of that 12,000 we have reversed. So 84,000 is the, okay. So here 600 into 10. Here 600 into 150. 160 minus 10, 150. So this is 90,000. 600 into 10, 6,000. And this is other equities, this one. Okay. So if you total it should be tallying. Is it tallying?
Sir,
Huh?
600 into 40, 24,000.
24,000. Okay. This is 24,000. 24. Now total it. Are you getting 1,08,000? Are you getting 1,08,000? And 600 into 150, 90,000. That is all right. 96 plus 12 is 1,08,000. Okay, so this is the way we have to do it. So that part here, this is the one. So which will be transferred to general reserve. This is transferred to general reserve. 100 into 120, 12,000. Transferred to other equities. Vested and lapsed. Transferred to other equities. Okay. So this is all we have to do it. Are you getting this? Are you getting this? Okay, right. Shall I go for the next one? Okay, right. Anybody is not getting, let me know. If anyone is not getting, let me know. Okay, all right. Go for the next one. Yes, Shital.
Yes, sir. Choice Limited grants 100 stock options to each of its 1,000 employees on 1st April 2014 for 20 rupees, depending upon the employees at the time of vesting of options. The market price of the share is 50 rupees. These options will vest at the end of the year 1 if the earning of Choice Limited increases 16%, or it will vest at the end of the third year if the average earning of 3 years will increase by 10%. 5,000 unvested options lapsed on 31st March 2015. 4,000 unlisted options lapsed on 31st March 2015, and finally 3,500 unlisted options lapsed on 31st March 2017. The earnings in percentage of Choice Limited are for the year ended 2015 is 14%, 16 is 14%, and 17 is 7%. 850 employees exercised their vested options within a year, and remaining options were unexercised at the end of the contractual life. Past journal entries for the above.
Okay, right. Before going to this, I would like to tell you something about the types of options. Okay. So in the ESOP, based on the condition, some condition has to be fulfilled, satisfied, then only you will be getting the reward for that, for fulfilling this one. So the first one we have discussed 3 years continuous service. If someone is there, then he will be allotted these many shares at the particular price, excise price. So if it is based on some number of years, then we call that as a service options. Okay, service conditions. So the conditions based on service based condition. Okay, so here they say that 3 years of service you have to complete, 5 years of service you have to complete, 2 years of service you have to complete. Then you are eligible for the entitlement grant. You are eligible for the grant. So that is a service-based conditions we call it. Now another one is non-service based condition. Non-service based condition or performance based condition. So the performance based condition, if it is not based on the number of years of service or something like that, then we call that as the performance based conditions. So for the grant, performance based condition also, it may be that you have to produce, see now the present capacity utilization is only 40%. The moment we achieve 80% of the capacity utilization, you will get a grant. Something like that. If they say that it is not based on the number of years of service or something like that, it's not based on the period. It is based on the capacity. It might happen today, it might happen tomorrow, it might happen anytime later, or it might not happen at all. So those things are, we call it as the performance-based conditions. Is that clear? What is service-based condition? What is performance-based condition? Is that clear? Is that clear?
Yes, sir.
Okay, right. Now, the next is in the performance-based condition. Market-based condition. And non-market based condition. Okay, what is this market based condition and non-market based condition? the market-based condition is based on the market. See, they say that the market-based condition, we have to, now the present demand in the market is, let's say 1 lakh units. We have to increase to 3 lakh units. Our sales should be 3 lakh units, something like that. Then it is a market-based condition. So the market demand we have to increase, that is a market-based condition. Or they say that our current stock price is 120 and we have to increase to 160. If our company is increasing the market price at 160 per share, then you will be getting. So these are all the things based on the market. Sales, creating demand, and capturing the market size and other things and all, that is market share and all, that is market-based condition. Or price increase in the security stock exchanges and all that and all, market-based conditions. Non-market-based condition, I already told you. So our current production capacity is 20%. We have to increase to 30%. Our current profit rate is, let's say profit rate is return on our equity is 20%. We have to increase to 40% or something like that. Maybe the productivity problem may be there. It is not exactly due to the market demand or something like that. We are based on the production facility or productivity. The laborers are not working properly. They have to put their full efforts and reduce the abnormal losses and reduction of overheads, better utilization of fixed costs. All these things are non-market based conditions. So two things are there. One is a service-based condition. It is based on number of years. When not based on the number of years, then we call those conditions as the performance conditions. The performance may be market-based. The performance may be non-market-based. The performance based on the market conditions are like increasing the demand in the market, attaining the sales share of market demand. So this type of things will be the R when you create the value in the market by increasing the value of shares and other things and all that and all market-based condition. Non-market-based condition is basically the productivity and improving the and the better performance and reducing the loss, reducing the unnecessary losses. So that and all the non-market based conditions. So this has been asked as MCQ questions about this. So here we are going for that. So here non-service based performance, the problem is the 7th one. Yes, now you can read it. Page number 6, isn't it?
Yes, sir.
Question number 7. Yes.
So, Choice Limited grants 100 stock options to each of its 1,000 employees on 1st April 2014 for 20 rupees, depending upon the employees at the time of vesting of options. The market price of the share is 50 rupees. These options will vest at the end of year 1 if the earning of Choice Limited increases 16%, or it will vest at the end of the 3rd year if the average earning of 3 years will increase by 10%. 5,000 unvested options lapsed on 31st March 2015. 4,000 unvested options lapsed on 31st March 2016, and finally 3,500 unvested options lapsed on 31st March 2017. The earnings in percentage of Choice Limited are for the year ended 2015, 14%, 2016, 14%, and 2017, 7%. 850 employees exercised their vested options within a year, and remaining options were unexercised at the end of the contractual life. Past journal entries for the above.
Okay, right. Let us go for this. So here they say here there are multiple conditions are there. There are multiple conditions are there. If first year you have attained your earnings are increases to 16%, then you will be getting, or it will, that is the vesting period will be 1 year, and if it not, then the vesting period will become 3 years. So when we will come to know, later on only you'll come to know, not immediately. And they said the earnings of Choice Limited for the first year is 14%, and second year and the 31st March 2016, 14%, and third year is 7%. So here the multiple options are there. The earnings, third year, if the average earnings of 3 years will increase by 10%. Okay, average earning is increased by 10%. The earnings percentage for the year 14%, 14% and 7%. So how much is the total? The total is 14 plus 14, 28, 28 plus 7, 35, 35 divided by 3. It is 10 point something it is coming. They say here 3 years average is 10%, more than 10%. Yes, it is more than 10%. Okay, the average earning of 3 years, end of the third year will be by 10%, increase by 10%. Increase by 10% doesn't mean that increase is 10%. Is they say that the average rate should not be less than 10 years. So it is 10 point something, it will be coming. How much it is? 11 point something, 11.67 if I'm not wrong. So 35 divided by 3 is, yes, 11.67% is coming. It is more than 10%. Therefore, only the vesting period, the grant will be approved. You are vested after third year, because first year you don't have 16% of earning. Second year also you don't have. The third year end, the average rate increases. It is more than 10%. Okay, so this is the understanding. We supposed to have this problem. For this problem, let's go for this first one. Okay, we have to find out what is the, I'm doing the work, then I'll do the entries. So first year, how much is our value of option? Let's see here. So fair value of option. Fair value of option is 50 rupees minus 20 rupees, 30 per share. So this is the total value of option that we will be doing, because there are different conditions, multiple conditions are there, and the multiple conditions are there. Generally for non-service performance based condition, there we have to do this way. Performance based condition we have to do this way. Okay, right. Now year 1, year 2, year 3. This is year 1, year 2 and year 3. Okay, this is on 31st March 2015, 31st March 2016 and 31st March 2017. These are the dates are given. So vesting period ends second year, because they say it is increased by 14%. So it is not increased. So first year end 14%. How can you find out the first increase? How can you find out it is not? Some 14 to 16 should go, 16 and above. So second year only we will come to know. So the vesting period is second year. It is not the first year. Number of options are how much? Number of options or number of grants. number of grants, what they say here, they say 1,000 employees are there and each employees will be getting 100 stock options. So 1,000 employees were there. Depending upon the employees at the vesting options, the market price is 50 rupees. The options vest at the end of the first year. One, if the earning choice limited increases 16%, or it will at the end of the third year, if the average earning is 3 years, will increase by 10%. 5,000 unvested options lapsed on 31st March 2015. So 5,000 minus into 100 minus 5,000. So number of options are here only 95,000. 5,000 options are lapsed before vesting. So 95,000 it is. So how will be 95,000 and per option it is 30 rupees. This is okay. This is big. Okay. Third C. So here total compensation expenses or total fair value of option on this date will be 95,000 into 30. How much is this? So 95,000 into 30 is 28,50,000. So 28 lakh. This is the first year. So 2 years option. So we will be okay. So expenses to be recognized will be 28,50,000 divided by 2. 14,50,000 we will recognize now. No. So first year we are assuming that the second year we don't know whether it will increase to 16% or not. In the first year and we won't get to know. In 1 year time it should be increased by 16%. So 1 year time means second year. So second year whether it is going to happen or not on 31st March 2015. 2015 we won't know what is happening on 2016. So we are assuming that it is going to be satisfied. The condition will be satisfied in the second year. That is what we are assuming here. Okay.
No, sir.
So that's
Either first year or third year only, no?
No, it is that is not the meaning. In 1 year they have to say that it is also again this one you can make the note here. They say that it is not the end of the first year. They want to say that it should increase from 14% to 16% in the second year. They never said that it should be 16% and above. What they say here, it should increase. The option will vest at the end of the year 1 if the earning choice limited increases 16%. Increase when you can do it. In 1 year time they are supposed to give, so they have given wrongly year 1. In 1 year time they are supposed to give here. So by the end of the second year they should have 16% of the earnings, but it didn't happen. Both the years it is 14%. It is a little bit this is the way it is written here. Increase when it will happen. So increase or decrease when you are comparing with another one, then only it will happen. Have they given the what is the earnings for the year 2013-14? They are not given. From 14-15, 15-16, 16-17 they are given. So the question supposed to be, it is an examination question, our exam question. Okay, it's supposed to be given at the end of second year. In 1 year time they should give, because there is no comparison. So we cannot, how can we compare increase or decrease? How can we compare? We cannot compare. Getting it? So just you can make a note of it. It is not end of 1 year. It is in 1 year time. Okay. Completion of 1 year. Completion of another one more year. Okay. So second year is the one they have given. So that is the meaning of this one. So divided by 2, we got 14,50,000 to be recognized in the current year.
14,25,000.
Okay, right. That is my mistake. So it is 14,25,000. Okay. So first one is over. The second year, here also, here we have come to know 14% is this one. So third year only it will end. Okay. Here also it is a third year. Yes, it is treated because what happened? 10% average rate of earning become 10%. Okay. The third year, how we have to do it, plus second year, how we have to do it. What the problem says, unvested options lapsed in 31st March 2016, 4,000, 5,000 unvested option lapsed 31st March 2015. And unvested options lapsed in 2016 is 4,000. So what will happen? Number of options here, 95,000 was there previous year, but now another 4,000 options, 4,000? Another 4,000 options lapsed. So here 91,000 options are there. So the value will be 91,000 into 30. How much? 91,000 into 30. 2,73,000. Okay, 2,73,000 is the total. This one, and this is total compensation. And okay,
The total is wrong.
what total is wrong? What is wrong?
Sir, 27,30,000.
27,30,000. It is one zero is left out. Not total is wrong. Multiplication is wrong. Arithmetical error. Doesn't matter. Okay. Thank you. Thank you, Anand. Right. So 27,30,000 in 3 years' time we have to create. How many years are over? Okay. So how many years are there? Out of 3 years, how many years are over now? Out of 3, how many years are over now?
2 years.
2 years. So 2/3 of the years are over. So 27,30,000 into 2 by 3. So this much till the end of second year we have to provide. So 27,30,000, yes, into 2 divided by 3. So to provide 18,20,000 we have to provide. Already we have provided. How much we have provided? Expense to be recognized. Expense to be recognized during the current year. Okay. I'll take another one also. D, E, and this F. Already provided. F to be provided. during the year. So here nothing was there, so we have provided 1425. So here 14,25,000 already we have provided. So current year how much we will provide? 18,20,000 minus 14,25,000. If you do that, then 3,95,000 during the current year we will be. Are you getting this? Total till the end of second year we have to provide 18,20,000. Out of that, already previous year we have provided 14,25,000. So the current year we have to provide 3,95,000. Is that clear? Is that clear? Okay. If you want to explain, I'll explain again. So right, third year. So here, what they say here, they say in the third year, finally 3,500 unvested options lapsed. So here 91,000 was there. 91,000 minus 3,500. So this will be 91,000 minus 1,500 is 87,500 shares are there. So the value will be 87,500 into 30 into 30. How much is this? 26,25,000. So rupees 26,25,000. We have to provide, and this is the last year, so entire amount we have to provide 26,35,000. Already we have provided, how much we have provided? We have provided 18,20,000 already we have provided. So currently we have to provide 18,20,000. So 8,05,000 we have to provide. So this we will be doing in case of performance-based conditions. In case of performance-based conditions or multiple conditions are attached, then this is the way we have to do it. So we suppose know what is the amount we have to get here. So first year we will be against 14,25,000. Second year 3,90,000. Then third year end we will be providing 8,05,000. Okay. Vested option lapse how much? 850 employees exercise the options. Okay. Total number of options exercised. 850 employees exercised. So 850 into each employees are allotted 100 shares. So 85,000 shares. So vested and lapsed options. How much we have provided? 87,500 we have provided. So vested and lapsed will be the difference. Okay. Okay. Total means vested 87,500. Vested options lapsed 87,500 shares. So amount to be transferred to general reserve. Other equity. What will be the entry? What will be the amount? How much will be the amount? 2,500 into 30. So 2,500 into 30 is 75,000 rupees. 75,000. So you can go through your problems. All the problems are like this only. It is there. And yes, one part is there. Share-based payments that I have not done. So because of the shortage of time, I'll give you time tomorrow or day after for this, about whenever we need to do that. So we'll be discussing by the time whatever the problems illustrations are there in the book. Please kindly go through it we will be getting all the problems. Everything will be getting, and I already explained you how, what is these things are there.
So tomorrow at what time?
Not tomorrow. It is tomorrow or day after tomorrow. That is what I said, in 2 days time. Okay.
Sir, at what time, sir?
It will be post 10 o'clock, 10 p.m. It is around 10:30, 11, something like that. Because there are
In
10:30, 11, something like that. Because I have to get free also from my commitments. So not before 10:30 p.m. It is post 10:30 p.m. Most people are here, the working people, employed. I don't know whether you have taken a leave or not. I don't know. So it will be post 10:30. About 1 hour, 1.5 hour, we have to sit and do it to clear your doubts in this area and complete the SAR. Okay. So security appreciation right. So these are the that one area we have to do it about 1 hour time, and we need to. I have to clear your doubts in this because I expect in the papers what I have seen here, the people have told me about 10 to 12 marks had come from this, all the papers. So one of the important area I feel. So that's the reason I take. Otherwise, I don't take this much time for this. Just I do two problems right away. I do the last problem and ask you to do the rest of the things. So I have taken time because the students have told me, those who are given the mock test, they have said, sir, it is about 10 to 12 marks is the weightage. 10 to 12 mark is a very, very good mark. So investing this much time is justified. So one hour or 1.5 hour we will be doing. So tomorrow or day after, subject to at least 5 people should be there. Okay. Right, friends. Any doubt in this today's class? Anyone? 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 Okay. Right. Others? Only Chetan and Sheetal has said, no problem, sir. Somebody has said, yes, sir. Sheetal said, I will revise, sir. Like that, others. No doubt, Urvashi. Vaibhav? Are going for both groups. Vaibhav? No doubt. Okay. 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 Right.